You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, what's up guys? It's Jonathan. I got the chat open. We actually have a little poll that we're running to start off this Thursday morning. Which of these do you think is the most important driver of market volatility? Is it tariffs, inflation data, tech earnings, or retail speculation? Well, I agree with you guys. Tariffs and global trade tensions is the winner. So let me do a little bit of an intro, guys. My name is Jonathan Rose. I've been a pro trader for nearly 30 years out here in Chicago, and I help regular folks trade like the professionals. That's why each day the market's open, I get on here and share some of my favorite setups, and I teach you strategies that I use to profit from them. And if you're one of my paid up all access members, at the end of the free portion of the video, all access members, hang on. We're going to talk about our live portfolio, talk about trade management, and help in any way that I can. Kind of a slow kind of morning, kind of a meh morning. We've had a lot of volatility in the market, and today, market's pulling back a little bit, but not much. We're going to talk about today a topic called the crack spread. It's something that I've been talking about these last couple of weeks. The crack spread is the profit margin for refiners. It is a great leader of all the refiners. Where the crack spread goes, all the refiners follow. It's a really, really great divergence trade that we take advantage of. Also, we're going to talk about our earnings advantage program. We are in the heart of earnings season. When earnings comes around, we have a rinse and repeat approach. We do the exact same thing every single earnings season, and I'm going to walk you through it. Let's go to the slide deck. I got the chat open. Ask some questions. Let's have some fun. Here we go. Here we go. Nathan, what's up, buddy? Hey, Denny, thank you for joining. Brian, Ken, everybody. I love the good mornings to start the day. All right, here we go. Now, this is something that we continue to talk about. And you know what? Why do we continue to talk about it? Because we talk about what works. I've been sharing videos on YouTube since 2015, guys. And if you go back to 2015, you'll see that the topics that we talk about in 2015 are the exact same topics that we're talking about right now. Following the crack spread is a very, very easy trade once it starts moving. So the crack spread is the yellow line. Now here, there's not that much to do. Everything's kind of range bound. Nothing is really going on. Once the crack spread starts to move, once the crack spread really starts to move, that's when the refineries will inevitably follow. Now, they may not react right away, but over time, the crack spread is literally the profit margin for oil refiners. So here I have oil refiners, VLO, PSX, and Dyno. Dyno falls, the refiners fall when the crack spread rallies. The reason why I'm showing you this every day is I want you to build your memory bank as well. Because the next time this happens, this is such a no-brainer trade for everybody. The crack spread is literally, the profit margin for oil refiners. So if we just keep things simple, crack spread starts moving. Kate got in $1.58, sold at $2.70. Roger was able to make 82.6%. Got out yesterday with Shelly. Shelly makes 100%. Rusty, 81%. Chaz sold at $2.65, in at $1.35. He's loving the crack tracker. This is the crack tracker. Why is it the crack tracker? Again, there's nothing to do here. But when the crack spread starts to move, refineries become absolute no-brainer trades. Dyno here, in for $1.40, out for $2.60, make just shy of $500. You know what we like to do when we have our good trades? We like to celebrate it with a glockenspiel. I tune my glockenspiel up. It sounds lovely. Great job. Well done, crack spread traders. Another trade we had, we're in the middle of earnings season. Earnings have been a really great trade. I didn't share D-Lo. D-Lo was a trade that was just shared in our earnings room. I think Eddie shared a D-Lo. D-Lo, boom, up 15%. Great, great trade. D-Lo, again, priced incorrectly going into earnings, and a trade that we were able to take advantage of, or that many in the room were able to take advantage of. I didn't share D-Lo. This is just a great example of the people in our community working together. This next slide is a big one, guys. I meant this one. This one's a big one. The other one's a big one too, but this is a bigger one. I want to go with this one. This is from this morning. What do we have? Take a step back. Nasdaq is tech stocks, right? Tech stocks is the Nasdaq. You can use the QQQ. We're looking at NQ. It's actually the futures, but it's just, look at them as tech stocks. RTY is the Russell 2000. Now, I look at everything as relative. Whenever I'm looking at an asset, I'm always looking at that asset relative to another asset. We can't value any asset independently. It bugs me to high heaven when people say something is overvalued or undervalued or oversold. Nothing is expensive or cheap. It's expensive or cheap relative to something else. The Nasdaq can be expensive relative to its recent earnings. The Nasdaq can be expensive relative to the Russell. The Nasdaq can be cheap relative to oil. Everything needs to be relative to something else. When you go buy a home, you don't just buy a home because you think it's pretty. You find a home that you want, and then you're looking at the comps of all the other homes that have traded around you because you want to see if you're getting a good deal or if you're not getting a good deal. Everything that we do in life, we're looking at a value relative to something else. So that's what I have on the screen in front of you. A really, really powerful chart. Now, since April 2nd, which was Trump's Liberation Day, which was right here. Since then, the Nasdaq has rallied relative to the Russell. So yes, the Nasdaq has rallied. But the interesting thing to me is the Nasdaq has rallied relative to the Russell. So let's say that you wanted to make a bet that this line would go down here. Just like we've done in the past. Just like we did here. Just like we did here. How could we take advantage of that, guys? If we wanted to make a bet that this relationship between the Nasdaq and the Russell would sell off and sell off back to, here, here, here. How would we take advantage of that? What kind of bet would we make? What do you think, guys? What would the bet be to bet on this line going lower and trading all the way down here? Let me answer. The bet would be you want to be short tech stocks, long Russell 2000, long small caps, and short Nasdaq. So if anything, some of your short-term holdings, guys, if you have a short-term holding where you're killing it on some Nasdaq stock after this really great move, it's time to sell. Why is it time to sell? Well, for a short-term trade, look at that action you got on Nasdaq relative to the Russell. So those are trades that we're going to be looking for. Right now, getting long small caps, it makes a ton of sense. If we see a summer melt-up rally, you're going to get far better return in small caps than you will in tech stocks because of this chart. Hopefully that makes sense. Does anybody have any questions about that? It's just a really, really simple way to look at the market, okay? Here, we're buying Nasdaq, Okay, we get up above here. Well, you're not looking to buy Nasdaq. You're not going to find any value buying Nasdaq. You're going to find value looking to the small caps. No questions on that? Everybody's good? That makes sense? Yes, yes, yes. I feel like I'm the only one raising my hand, and I'm not even sure why. Seriously, I'm not even sure why I'm raising my hand. Dimitri, that's what I'm trying to do. Repetition, repetition, repetition. Really, it's the same thing over and over and over. What we're teaching is the same thing over and over. It's just different ways to look at it. Here's a cool chart for you. Look at this one. Appreciate all the yeses, my friends. This is 1 year, guys, going back to the beginning of January. This is called a Nasdaq Butterfly. Now, why is it a Nasdaq Butterfly? It's the Nasdaq against the S&P, the Dow, and the Russell. Now, this one is the Nasdaq against just the S&P and the Dow. But what I'm showing with this chart, this move right here, it's really the Nasdaq. The Nasdaq is where all the vol is. So this is the Nasdaq getting cheap relative to the S&P, relative to the Dow, relative to the Russell. So here, the trader that buys Nasdaq and sells the other, you're actually making money. And that's how much the Nasdaq has recovered relative to the others. But this also shows us, I'm going to get to your question, but this also shows us that the Nasdaq has recovered. The others haven't really. S&P's cheap, Russell's cheap, Dow's cheap. If anything, the Nasdaq is getting expensive. 2 questions. I got Roger. With the trade deals and inflation cooling, might both yeah, Roger, 100%. Might both the Nasdaq and the Russell shoot up? Absolutely. My message to you is you're going to get better value in small caps right now. I wouldn't be surprised if they both ran up. If that's the case, you're going to get much better return in the Russell and not the Nasdaq. Why would you not short the spread in the middle of the chart? So I believe you're talking about the previous. I believe you're talking about this one. And you could, but I'm guessing that we're all not just short-term futures traders, right? So as investors, this chart takes us back 5 years. It's just trying to keep you out of trouble. So it's not necessarily let's bet against the Nasdaq and let's bet for the Russell. The better message is if you're bullish, look at the Russell. If you're bearish, you want to look at expensive tech stocks. You could do this trade, but you don't have to. The point is that you want to make sure you're long what's inexpensive and you're short what's expensive. So if you're sitting there with 10 Nasdaq stocks, 10 tech stocks, sell 5, buy some Russell. Is a great way to diversify that portfolio. One other question in here with a very difficult name. Why not short the spread in the middle of the chart? What length of time play these bets? Well, Richard, when you're talking about time, you could just look at the chart. It looks like a couple of months for these things to move. It would be a loser. So we're not talking about necessarily just trading the spread, but what we are talking about and how we do trade is when we see moves like this. Nasdaq gets very, my mouse is being a little bit slow. Okay, spreads don't move like this. That's why they retrace. These are not outright contracts. Remember, these are spreads. So it takes quite a bit of oomph to get this thing moving. And that's why we look at things one against another. It's a change of thought a little bit. It's a change of mindset a little bit. But once you do, it's a lot easier way of approaching the market. I got one more slide that I want to share with you. Aaron, you said the same idea several times over the last few months. It didn't work well those times. What's different this time? Well, Aaron, my friend, if I'm sharing that idea over and over, let's look at that chart again. Right? They're moving. If you're sharing the same idea over the last couple of months, when Nasdaq's cheap, we're looking to buy. When Nasdaq's expensive, we're looking to sell. So Aaron, I'm not sure if you're in the community at all, but over the last couple of months, we're traders. These are active. Yes, sir. It's a relative trade, my friend. We're looking at one against the other. The next trade that I'm going to share with you guys is I want to pull up this chart. One sec. Oops, I didn't mean to do that. I got to pull up a window here, new window. And let's go to Masters in Trading. And what I'm going to pull up right now, guys, is our unusual options activity tool, which is called Advanced Notice. I'm going to move this off screen. Open this up. So if we look at Advanced Notice, and our Advanced Notice is our unusual option activity tool. The biggest value that I see in unusual option activity is once in a while, you'll start to see sectors coming up. And if I go back to Wednesday, May 7th, we see run here popping up. Run started to come up on the unusual option activity scanner at $7.39. Run $8.50. And run is solar. Run $9.38. And now we start to see sedge pop up as well. And then we start to see First Solar pop up as well. On Monday, now First Solar takes number one. Sunrun is still there at 1096 now. So you see that when it started to come up, it was 750, 850, 950, 1096. Tuesday, Sunrun, 1190. First Solar is now second. EMP is now on there as well. So what I'm showing you is slowly FL pops up yesterday before getting bought. Run again. Fissler. So what we've been seeing, guys, is solar names. Solar names steadily coming into the screener. And if we look up here, and if I list not all the solar names, but the solar names that are tradable, you got Run right here, Fissler right here. And this is JKS. That's going to be Canada. I'm just going to write CAN for Canada. And then China. So what's happening is that we are seeing unusual option activity names that are coming for US solar. Usually when we see advance notice, unusual option activity, they come in bunches. That's what we're seeing right now. So the solar area is absolutely in play. I don't know what's going on with it, but we are actively involved in the solar sector because that is where we are seeing a lot of unusual options activity. Hopefully that makes sense. Hopefully you guys enjoyed that. Actually, I'm at a conference today. We have an AI conference that I'm in throughout the day. I'm taking a little break to get my Masters in Trading Live done. All access. You guys hang out tight. We're going to go over our portfolio a little bit. For everybody else, thanks for watching. Give the video a thumbs up. Make sure you subscribe, and we'll see you tomorrow live, 11 a.m. Eastern Time. Thanks, guys. My name is Jonathan Rose. Appreciate you watching.